Hello and welcome to our YouTube channel. Today we're going to be discussing the top 10 investment strategies that you can use to grow your wealth and achieve your financial goals. As always, make sure to like and subscribe to the channel to stay up to date on all of the latest news. Let's get started. Number 1. Diversification. One of the most important investment strategies is diversification, which involves spreading your investments across a variety of asset classes and sectors in order to reduce risk. By diversifying your portfolio, you can protect yourself against market volatility and potential losses in any one particular area. For example, you might invest in a mix of stocks, bonds, and cash, or you might invest in a range of sectors such as technology, healthcare, and finance. Diversification can help to mitigate the impact of any individual investment underperforming, as the overall performance of your portfolio will be less reliant on any one asset. Number 2. Dollar cost averaging. Another effective strategy is dollar cost averaging, which involves investing a fixed amount of money at regular intervals, regardless of the price of investment. This can help to smooth out the ups and downs of the market and can be a good way to gradually build a portfolio over time. By investing a fixed amount on a regular basis, you can take advantage of lower prices when the market is down, and also benefit from higher prices when the market is up. Dollar cost averaging can be a good strategy for those who are just starting out with investing and want to build a portfolio gradually over time. Number 3. Asset allocation. Asset allocation involves dividing your investments among different asset classes, such as stocks, bonds, and cash, in order to achieve your desired level of risk and return. By properly allocating your assets, you can help to minimize the impact of market volatility on your portfolio and increase your chances of long-term success. Different asset classes tend to perform differently under different market conditions. So, by diversifying your portfolio across multiple asset classes, you can potentially reduce your overall risk and increase your chances of achieving your financial goals. Number 4. Long-term investments. Long-term investment involves holding onto investments for a period of several years or more in order to take advantage of the potential for compound growth. This can be a particularly effective strategy for those who have a long time horizon and are comfortable with a higher level of risk. By holding on to investments for a longer period of time, you can potentially benefit from the compound growth of your investment, as the returns from your initial investment can be reinvested and generate additional returns over time. However, it's important to note that long-term investing does involve a higher level of risk, as the market can be volatile in the short term, and there is no guarantee of success. Number 5. Value investing. Value investing involves identifying undervalued stocks or assets and buying them in hope that they will increase in value over time. This strategy can be effective for those who are willing to do their due diligence and are comfortable with a more hands-on approach to investing. Value investors typically look for companies that are trading at a discount to their intrinsic value, with the belief that the market is undervaluing the company and that it has the potential to increase in value over time. This can be a more conservative approach to investing, as value investors are generally more focused on minimizing risk and preserving capital. Number 6. Growth investing. Growth investing involves focusing on companies with strong potential for growth, such as those in rapidly expanding industries or those with innovative products or services. This strategy can be riskier than value investing, as it involves a higher level of risk in exchange for the potential for higher returns. Growth investors are typically more focused on maximizing returns and are willing to take on a higher level of risk in order to achieve this. Growth investors may be more interested in investing in newer, fast-growing companies rather than more established firms, as they believe that these companies have the greatest potential for growth. It's important to note that growth investing does come with a higher level of risk, as the market can be volatile and there's no guarantee of success. Number 7. Index investing. Index investing involves buying a basket of stocks that tracks a particular index, such as the S&P 500. This can be a simple and low-cost way to invest, as it provides broad exposure to a diverse range of companies. Index funds are passively managed, which means that they are not actively selecting and trading individual stocks, but rather are designed to track the performance of a particular index. This can make index investing a more passive and low-maintenance approach to investing, as it does not require the same level of hands-on management as actively managed funds. Number 8. Real estate investing. Real estate investing involves buying and holding onto properties in order to generate income through rent or to benefit from appreciation in the value of the property. This can be a relatively stable and passive form of investing, but it does require a significant upfront investment and can be subject to market fluctuations. Real estate investing can be a good option for those looking for a more tangible asset to invest in and who are comfortable with the added responsibilities that come with owning and managing a property. Number 9. Alternative investments. Alternative investments include asset classes such as private equity, hedge funds, and commodities, which may offer the potential for higher returns, but also come with higher levels of risk and complexity. These types of investments may not be suitable for everyone, but they can be an option for those looking to add diversity to their portfolio. Alternative investments can be more risky and complex than traditional investments such as stocks and bonds, and they may not be as liquid, which means that it can be more difficult to sell them when you want to. As such, they may not be suitable for everyone, and it's important to carefully consider the risks and potential rewards before making any investment. Number 10. Active versus passive investing. Finally, one important consideration when it comes to investment strategy is whether to take an active or passive approach. Active investing involves actively selecting and managing individual investments, while passive investing involves simply buying and holding a diversified portfolio of assets. Both approaches have their pros and cons, and the right choice will depend on your personal financial goals and risk tolerance. Active investing can potentially offer the opportunity for higher returns, but it also requires a higher level of time and expertise, as you need to be constantly monitoring and managing your investments. Passive investment, on the other hand, can be a more hands-off approach and be more suitable for those who don't have the time or expertise to actively manage their investments. Overall, there are many different investment strategies to choose from, and the best one for you will depend on your individual financial situation, goals, and risk tolerance. It's important to do your research and seek the advice of a financial professional if you're not sure which strategy is right for you. Thank you for watching. We hope that you found this discussion on the top 10 investment strategies helpful and informative. Make sure to like and subscribe below to stay up to date on all of the latest news. We will see you next time.